Welcome to this week's live ASX strategy session. And again, thank you for joining me. Great to have you with me. As always, we're going to be discussing the ASX 200. We're going to go on to the small caps, have a look at gold, copper, uranium, and I've also got another couple of interesting stocks to show you and talk a little bit about later on. I'm going to save the Q&A until the end, as we usually do, so we can just keep the usual flow going through, and then we can look at a few of your questions and some of the things that you're thinking about. As always, everything we talk about today is general commentary only, not personal advice. It's general only. And I'm quickly going to share a disclaimer. So that's just because we're live. I've just put the disclaimer up. When it's on YouTube replay, that there's a link to it. But being live, there we go. So general advice only. Doesn't take your personal situation into consideration. So anything you hear here, it's not tailored to you. So you've got to go and do your own research and check out what's going to be right for you. All right. So with that said, let's get into a few of these charts. It's been a very interesting week. So I'm going to go over and have a look at the ASX 200 first. So there we go. We've got the ASX 200 up there, and look, the situation since last week has really deteriorated, especially over the last couple of days. And this has always been, I think this has really always been the risk, particularly over the last few months. We've had a situation where the market's been below these declining moving averages, and over the last week, it was encouraging. We had that good rebound off the lows probably about 3 weeks ago now. And what we found last week, the market then got stuck beneath resistance, coming in at around 7,070. And look, as we know, over the last couple of weeks, over the last couple of days, it's really come back. And this is always going to be the case when we're below declining moving averages. It's a vulnerability to the market, and when a market's vulnerable, we've got to be prepared for this sort of thing. Momentum is very much to the downside at the moment. I think the next key level to watch is pretty close to where prices are now, coming in at around 6,840-ish. Picks up an important low from back here in March, also another low from back in January. So I think they're the points to keep a close eye on for just the near term. Is the market going to be able to rebound off this or continue lower? My fear would get some sort of a rebound before potentially a break lower. Maybe a break lower doesn't happen, but this is very much the level to keep an eye on now. As you know, I've been optimistic that this pattern from the last, or this sideways trading that we've been in for the last 6 months could resolve to the upside, and that so far that's clearly not been the case. And but the thing is, we've just never had the price action to really support taking action on that possibility. And I think this is an important thing to keep in mind. It's like we can have views in where we think the market could go. We can look at possibilities, but then we've got to be guided by the price action. And the price action has never said, okay, right, we're breaking outwards now. It's been a sideways range, which is now starting to move to the downside. For me, as I've told you the last few weeks, it's been a case of exiting those stocks that are hitting their exit stops, and not being in a hurry to buy too much. And I think that's just the way to play these. It's not a case of buying dips, especially when markets are below moving averages. That's not the type of dip I'm interested in buying. Now let's just jump over to the weekly chart. There's something I want to show you on that. It's well, firstly, you can see that the current price action takes the ASX 200 to the lower end of this range. The market's been in pretty much all year. We've been in this sideways range. We're at the lower end, so we haven't broken to the downside yet, but we're very much at the lower end on support. And but I do think we need to be prepared for the possibility that this support will give way. And we've got the moving averages above, so we're below the moving averages. This is a weekly chart, so the averages here are a 50-week and a 100-week moving average. market hasn't been able to retake those averages as yet. So the vulnerability does remain to the downside. So one possibility that I want to float is a scenario similar to 2011. So let me just compress this a bit. And this is the 2011 period within here. So we had a situation where the market was rallying off the GFC low. So it was a strong rally, not dissimilar to the strong rally we had off the COVID lows. And then it was a case of the market pulling back, rallied again, and then had a final decline before a larger rally started. So it was your classic zigzag. The market came down, up and down. Could that sort of scenario unfold here? We've had the strong rally and then the zigzag, the down, the up, and the down that comes back and retests those August 22 lows, maybe go below it. That hasn't been my preferred view, but it's a view which I think we do need to at least have in mind at this point. And this is why I'm hesitant to buy dips when the market's in a vulnerable position, because I'm aware that there is a bearish scenario which could see the market come back to these August 22 levels. So I don't know whether or not that's going to happen, but it's a possibility which could play out. And my way of preparing for that is to just be slow to buy stocks at the moment. I'm not in a hurry to buy stocks. I'm also holding more cash. I'm actually somewhere around 50% cash at the moment. And I'm not out completely because I've got stocks which are still in upward trends. They might be consolidated within those trends, but they're still in upward trends. So it's not a case of getting panicky and going out there and just selling everything, just hiding in cash because we're expecting the worst, because the worst may not happen. So it's not a wholesale selling event. It's a case of selling what needs to be sold and holding what can be held and seeing how the market plays out. Market could come back, retest these lows. It could do all sorts of things, but it also could still, it's not inconceivable that it still bases and can rally in the near term either. So that's why it's not just going out there and just selling out everything. And I'll show you another thing which is interesting. This is an ETF. It's a BetaShares ASX 200 Financials ETF. And I'm going to go back to a daily chart on this. I showed you this a few weeks ago. And really interesting setup in this, because we've got this distinct downward trend line, which picks up several tops in price action. And then since at least March, we could even go back to June in 22, we've got a series of higher lows as the market's been ratcheting higher, but it's been compressing within this big broad range. And then we also have a smaller range which has formed since around July. So I think this is a key sector for the ASX 200, and it's really a key moment for this sector. What's going to happen here? Are these previous lows from August and October going to hold with the market coming back, or are they going to break? And I think that's going to be telling and I think it's going to have a big influence on what the ASX 200 does. If there's any chance, I think, of the ASX 200 basing anytime soon, I think these lows in the financials have to hold. If the financials can hold and if they were to break to the top side, it really does change the overall ASX 200 picture. But we've got to see. We're just waiting. We're waiting for breaks at the moment. We're dealing with a range-bound market where it's where you just can't hold strong convictions on anything. It's like know your levels, know what to hold, and know when to sell what's not working. Jumping over to the let's jump over and have a quick look at the small ords, the ASX small ordinaries, and all that can be said here is it's been a disappointing week. We got the rebound in the previous week off the base of this large trading range that the market's been in since around June 2022. So over a year now, stuck within this large range. We've got to bounce off the base of it, but it was a short-lived bounce, and the market is right back here retesting those lows. Not exactly an unexpected event, given that the market's been below these declining moving averages for since at least early September. So the momentum has been to the downside. I think it's a case that we just got to continue to respect that the market's below the moving averages and remains vulnerable. We've got this support coming in at around 2,600. Whether or not we get a base off here, I think now really is just a case of it's about protecting capital. This is all about protecting capital here. It's not trying to pick low points. It's not trying to be the first in when the market bottoms. It's stand aside, let the market do what it's going to do, and exit and hold according to the individual price action in stocks. I don't want to be trying to preempt a low because there's just too much risk with doing that. It's wait for the price action to tell us that it's now time to step in and start to increase risk. But at the moment, that's just not the case. Now we're going to jump over and have a look at some commodities in a moment. But if you're getting value, please hit that like button. Please leave a short comment. If you're watching the live, you can't leave a comment in the usual YouTube place. But if you're watching the replay, please leave a comment. Say, hey, thanks for the video. It just tells YouTube you're watching and YouTube will show other people. Hit that subscribe button if you haven't already done that. And if you want to get an email notification from me when I'm doing these videos, I give you a link to come directly to the video. There's the link in the description section below. You can just click that and you register your details and I email you rather than having to stumble across this or wait for YouTube to send out maybe some sort of a notification. So think about doing that. Now, okay, let's jump into a few of our commodities, and we'll start off with gold, because gold has certainly been the big mover of the week. It's been, well, look, in the last couple of weeks, gold cycled from close to 1,800 to close to 1,980. So $180 move in a couple of weeks. Very big move. The strength that we've seen in the last week, it's really taken me by surprise. I thought this was potentially, look, we had this V-shaped recovery, which we were talking about last week, but I thought gold may have paused beneath this resistance at around 1,880, below resistance, below the moving average. See what happened there, see if it was a shallow consolidation, then potentially up. But forget all that, it's just gone straight up. So really powerful move. Just jumping over to the weekly chart, just having a look at how it all shapes up on this. And I think this whole consolidation that we've been sitting through since really it's coming up to actually, well, it's over 3 years now, since August 2020, gold's been in this big sideways range. I think this is very much a bullish chart structure, and I ultimately think it's going to resolve to the upside. You'll know this setup we had back down here, which I've spoken about in the past, where we had the double top, we had the sideways, had the nilly breakout, the consolidation and the break. I'm wondering whether we've got the same sort of setup in play currently. I think it really does look good. That's been the case for a while. Coming back to the daily, it's now a case of, though, like, is this it? Is this the start of the next big advance? And I think one thing we need to keep in mind is that a lot of this move, there's a lot of news going on at the moment. There's a lot of you got the fighting in the Middle East, in Israel, Gaza. It's a lot of news flow going on at the moment, and that's more than likely going to be having a significant impact on the price of gold. Need to remember what happened when we had the Ukraine invasion also led to a strong period which lasted several weeks, but then that ultimately subsided and price came back. I think we've got a different chart structure now, in that this platform that's been developing over the last 3 years is a lot more advanced than it was when we had the Ukraine invasion. So I'm not looking for another pullback like we saw following that period. But I think some sort of pause is likely, some sort of pullback to the moving average. And that typically happens. You look at periods where the market quickly, where's a good example? Here's an example here where the market goes from below the moving averages, quickly goes above them. It does tend to come back to those moving averages at some point. Something similar happened back down here in October, above the averages, pull back to them. So I think some sort of pullback to the averages would be a likely scenario. And then, and depending what that looks like, if we got some sort of a choppy, shallow, sideways consolidation while these moving averages turn, like they actually haven't even crossed yet. So it's very early stages in, I think, this possible turnaround. And depending what that looked like, that could set up a really nice asymmetric entry opportunity. But let's just see how this price action plays. I'm not in a hurry to go out and just buy gold today. I've already got gold. I've had gold for quite a while. I've got those longer term holdings. I'm very happy to keep holding them and keep watching for new entry opportunities. Just quickly looking at the at Aussie gold. And I've got the don't usually look at the Aussie gold, although we've looked at it a few times. I think the last time might have been back around March, April, when price was breaking out of this large trading range Aussie gold had been in, gone through a sideways consolidation, which often happens after the breakout from big ranges, and just in the last week headed up, and I'm pretty sure that's an all-time high for Aussie gold. So look, all going well for anyone who's holding has that Aussie gold holding. But the thing which remains out of sync with this whole gold story are these gold stocks. So this is the Van Eck Gold Miners ETF. I'm showing the one which is listed on the New York Stock Exchange. We've got the local listing, the ASX listing. It's less data. It's more thinly traded. I like looking at the US one because there's a lot more data. This whole period, it's interesting when you compress this chart. This whole period from August 2020, so this is when gold made its peak. You can see how the gold stocks have underperformed the metal, where gold has like a triple top running along from its August 2020 high. The gold stocks have generally been pulling back. It looks like it's a big corrective sort of structure, but we don't have enough yet to say, well, okay, this is now starting to turn to the upside. Moving averages haven't yet crossed. It's a sort of structure which could develop into some sort of a base. It's what I'd like to see would be some sort of like maybe some sort of chop. If gold was to consolidate that recent move, some sort of chop and then a move higher with the moving averages turning up with it. And that's where you could start saying, oh, look, maybe this is some sort of a basing structure. Maybe some sort of a head and shoulders structure, like a shoulder, a head, a retest, some sort of a decline which doesn't follow through to the low, and then a breakout, something like that, to say, look, maybe there's some sort of a basing structure, but at the moment I just don't know that we have enough. We've got a good move off the low, so that disengages that immediate downward momentum, but it's still we don't have that clear point where we can say, look, gold stocks look to be turning higher. That said, though, I'm going to show you my favorite ASX gold stock in a moment. So stick around for that. We'll get to that in the stock section. Just quickly jumping over to copper, and look, copper continues to. This is the copper stocks. This is the COPX, the US listing of the copper miners, an ETF. And this just continues to give way. It's below these declining moving averages. It's right on support here at around 34.50. Looks like it's on the verge of breaking that support. Momentum remains to the downside in the copper stocks. And if we just come back over, and we'll just go back and look at copper itself, and just looking at the copper price, and there's just been no bounce off the low at all. It's barely moved, hasn't rebounded like gold. This has been a really shallow bounce, and a shallow bounce below declining moving averages is it just brings vulnerability to the table. So it's not an area which I want to play at the moment. There's no clear sign of a base we can put in some. You can put in some support if we. I can just line this up. We get some support coming in, probably around the previous low in May. There's some work back here around October. It's kind of sitting around an area where some support could come in, but it's not enough for me to say, well, look, this is a time to buy. I think it's look. I like that longer term story. It seems to have a great longer term story, but the price action just doesn't agree at the moment. Continue to weaken. I think it's a case of watch and wait. And what's also interesting is this currently isn't a broad-based commodities move. So gold is running, but we're not seeing it in copper. We're not seeing it in plays like nickel. Oil is getting some momentum, but it's still pretty messy. Iron ore is not running. It's not a broad-based commodities move. We've got stronger US dollar. So yeah. I just want to watch that gold price. Watch those gold stocks. See if the gold stocks start coming into line. Now let's jump over and have a look at uranium. And good week. It's been a good week in uranium. Continues to consolidate after reaching a big high point in late September. And it's a case of something like 2 months, just over 2 months. Uranium's run 54%. So even though we're having this nice bounce, I do think that upside is probably limited in the near term. And it's interesting when I go down and I look at some of the uranium stocks. So say we have a look at Cameco, that's the big Canadian producer. And you see, quickly going back to uranium, notice how uranium is closing back in on its high. So then looking through some of these uranium stocks, Cameco is a little bit further back. It's not closing in on its high as quickly. And we look at a stock like Paladin listed on the ASX. It's nowhere near the high from a couple of weeks ago. What's Boss Energy doing? Boss Energy, again, it's selling off today. It's closer to its recent low than its high. And Bannerman, one of the stocks I've spoken about recently, again, it's not getting up near that high. So there's that possible divergence in the near term between the stocks and the uranium priced ETF. So my thinking remains that, well, my feeling is that we're looking at potential of a multi-month correction around this uranium space because it has been that really big run. It does need to consolidate. It just can't keep going up 54% every 2 months. That's not going to work. So you've got to get those big consolidations. That's all part of the play. Just look what the stock markets are doing now after that big run from the March 2020 low. It's taken, it's a couple of years of consolidation. Not saying that's what we're looking at uranium, but big moves do require consolidations. And that said, I think it's still one of the better longer term plays out there. So let's have a look at a couple of stocks. I was talking about a couple of stocks which I wanted to show you, and let's dive in and have a look at those now. So the first one, I'll start with the gold stock, which I like, and I've got it down here in my list of gold stocks, and it's Evolution Mining. So this is a really interesting one. So ASX listed Evolution. It was the third largest listed ASX stock. It's now the second, with Newcrest bowing out, being taken over by Newmont. And so this is an interesting play. It's also the with Newmont with Newcrest going, Evolution also becomes the second largest producer in the Australian ASX listed gold sector. So it's I think you'd call it a top tier gold stock. Market cap, I think the market cap is around $6.5 billion. So it really is a notable company. So having a look at this, and what's interesting here, so moving averages crossed back in December. We've had upward momentum since then. And what's been happening since May? We've been in this sideways consolidation. We've got support on the downside at around $3, around that $3.20, 25 sort of mark. And you can see this support stretches back, goes back to March 2020. So you can see it's been this technically active region for over 3 years now. And on the top side, you can see where I've got the resistance drawn in, coming in at around $3.90. So we're in a range at the moment. Interesting price action a couple of weeks ago in that we started to break to the bottom of the range when gold was down testing 1,800, and but that's now showing up as a false break because we've had the swift turnaround, the V-shaped turnaround, and we're now heading back up towards the top of the range. So I think this is I think there's a couple of ways to play this. So the motion trader signals were just after the moving averages crossed in December. And we got a second one just around in early May as they broke out of this little consolidation pattern. That didn't continue, and immediately we've been through this consolidation, but that momentum remains up. So it's one of the ones I'm watching because it's an active motion trader stock. It's one I actually hold some of myself. I've held some of this for a while, and I think what can be done here with this? Like I said earlier, that I don't like preempting breaks from ranges. I actually considered buying some of this week because I think it's one of those ones where if you're going to preempt the break from a range, it's one of the better ones to do because you know where your risk is. So the motion trader stop is currently at $2.90, just where you can see the cursor on the screen. So it's not that far from the current price action, considering it's a gold stock and they can move around quite a bit. And we've also got this notable low from a couple of weeks ago. So I didn't add to my position, but I did think about it. Because I know the risk is relatively low compared to the upside, like should the gold stocks turn and rally, the upside is back towards and beyond the 2020 highs. So you got good upside potential and relatively low risk. Doesn't mean it's going to work out. A lot of these setups don't work out, but it's a case of if you can keep your risk relatively small, when they work out, it doesn't do that much damage. So when they do run though, you can do really well. Looking for those asymmetric setups. So this is shaping up as an asymmetric setup at the moment. Now the other stock that I've had a look at through the week is one called EML Payments. So let's just call that up. So this is one which is, well, look, it's been a debacle from the 2021 high. It's really completely come apart. But just because it's had a bad period doesn't mean that bad period is going to continue. So what's interesting when you get like a stock which has been so out of favour is a lot of people just stop watching it, and that's when a nice recovery play can sometimes come about. So let me just expand this chart, get it so we can look at the recent price action. So the first thing I'd notice on this, and just a little bit about EML, it's a global payments company. Operates, they're in Australia, the UK, across Europe, and also in the US. So they've got good global reach. Market cap's around that 420 million mark. So it's a lot smaller than it was a few years ago, but it's still a company of notable size. And they also seem to be increasing their revenue quite quickly over the last few years. But go and check all that sort of stuff out for yourself if you want to understand that fundamental story a little bit more. But just a little bit of brief background. So what's interesting from a charting perspective is we've got this rounding basing structure. So you can see how we've had this period of declining lows. Then the lows lose their momentum. We stop seeing lows, and now we've been seeing a period of higher lows. So you can see the low points have been getting higher over the last 6 or so months. Also, for those who like their technical analysis, you could also call this a cup and handle pattern. It's I won't talk too long about technical structures like this, but they say in the charting books, a cup and handle formation is where you get the rounding bottom, which is the cup, and then you get the sideways consolidation, which is the handle, and the trigger point is the breakout, and then you can potentially get that nice move higher. Everything's potential because none of these patterns work all the time, but they're just common setups that Or they're useful setups that you can often associate with turning points, and with good risk management, you can make some money out of them potentially. And so the Motion Trader signals for this, Motion Trader signal came in late August, just as the prices was. So just you can see firstly just the moving averages. You saw the moving averages cross in June, got the initial break high, the sideways consolidation, which came back to the moving averages, the 50 and 100 day moving averages, as I usually have on board. So that was nice. We had the strong move up, the compression, the sideways compression back to the averages, another strong move up, and now we're getting another sideways compression back to the averages. Also interesting. I'm going to quickly put on a volume study, and you'll see when we do this that we had this really nice uplift in volume as the price was breaking high from this basing structure, and volume has really dropped away as we've gone into the sideways consolidation. So that all shapes up. I think it's a really interesting setup, and I think it's also interesting that it's been holding up so well over the last few weeks with what we've been seeing in the ASX 200 and what we've been seeing in the small caps. That ASX Small Ordinaries really coming away, where this has been holding its ground. So that's interesting in itself. I think that, look, in the current environment, this is not a buying rich environment. It's a vulnerable environment. It's a risky environment. I don't think it's an environment for bold plays. But for someone who is interested in a stock like this, and price action certainly is interesting, I think maybe the safer play would be buying on a break above this week's high, Wednesday's high at around $1.18, $1.19, and going looking for momentum, because we're so close to that high. For the sake of a few cents, maybe it does just continue to it may not break higher. It could just ebb away now, and the pattern breaks down. So that can be controlled through an exit stop, buying at current levels, putting an exit stop just back below the recent lows. Or the other strategy, or alternate strategy, would be potentially just waiting for a break above that recent high. If you get that breakout, maybe going with the breakout and seeing whether that breakout then runs. And as I say, you just never know. Breakouts don't always run. But an interesting stock to have a bit of an eye on. So look, with that said, I think we should get into a bit of Q&A. So I've been asked about TLX. So let's just call that up first. TLX. So this is a Motion Trader stock that hit its exit stop last night, I think, on this decline. Pretty sure they'd hit an exit stop. Look, if it was in my portfolio, I'd be exiting it because it's hit my exit stop and it's below declining moving averages in a vulnerable environment. It's not a stock I'd want to hold and hope was going to recover. Look, sometimes these stocks do break down and they form a base. You look at this period here. In September, it broke down below the averages. Had you had your stop loss, near the lows in September and sold, you would have been upset as the stock continued to rally, turned around and rallied. But we don't know. We don't know what's going to happen. Are we at this point, or are we at more like a point like in February 2022 where it continues to decline? And nobody knows. But you've got to work out, okay, where's balance up your regrets. What would cause you the most regret? Would it be exiting at current levels and watching the stock rally, or holding in the hope of a rally and watching the stock continue to decline, and watch it come back to $3 and going, well, geez, I knew I should have sold. I should have sold, but I didn't. I held on. So sometimes you've got to look, where's my greatest regret going to be, and go with that. Manage your risk and accept that we're not going to get it right every time, but we want to make sure we stay in the game by not getting stuck in stocks which decline. I told you about one of my stocks last week, AVH. It was not a dissimilar situation in that I had hit the exit stop. It was below the moving averages, and I got out. And look what's happened since. So I'm really glad I did the disciplined thing for me, and got out. Now, TLT, so I'm imagining that's the bond ETF. So that's a US listed one. Just check, is there I'm looking down here for an Aussie flag, just making sure it's not a local stock. No, so it must be the US ETF. I'm going to talk a little bit more about bonds in the S&P 500 video that I do. At the moment, this downtrend is so clearly in place, declining moving averages. I think there've been a lot of people trying to pick the low on this because they say, well, you look at the 10-year yield is at 5%. It's a big support point or resistance point, depending on how you orientate the chart. A lot of people trying to pick the low, and that's always dangerous because it always opens the event that you get an overshoot and the market just runs a lot further. I don't want to play in this. I think it's just too risky. It's not a low point I'd want to be picking. Someone could have tried to pick the low in August. They could have tried to pick the low in September. It keeps going away. Why is this going to be different? There is a structural support on the 10-year US yield at 5%. So maybe that's a reason someone might want to punt the low, but it is, I think the operative word is punt. There's nothing really to hinge off on this chart to say, this should be something we want to buy. I think there's too much risk. I've been asked about MTO. I think that is, Motorcycle Holdings. I looked at this a couple of weeks ago, and this was my interesting stock of the week, I think 2 weeks ago, and nothing's really changed. It's the moving averages have crossed. It's a little bit like EML in that it's holding up well in a pretty unimpressive market. It's sitting on the 50-day moving average. We've got this compression sideways. I'd be hesitant. Look, given the state of the current markets, I'd be hesitant to buy something at this point. Like that strategy I was talking about in EML, I'd rather buy a breakout, buy a break above the recent high, rather than look. It's possible to buy a low here, and you have an exit strategy, so you can still manage risk and still be asymmetric in that relatively small risk, large potential upside. But I think that works better when you've got a general upward trend within the ASX 200. The ASX 200 is above rising moving averages. I think that play works better then when you've got so much upheaval in small caps generally. Even though it's relatively strong, it's holding up so much better than many other stocks. I'm just being defensive and I'm being conservative. It's just the way I'm playing it. It's not my way. Is not for everyone. It's just my way. I'd rather buy upward momentum at the moment than pullbacks. Now, I've been asked about EMR. Where's EMR? Emerald. Yeah, that's an interesting one. So it's a motion trader stock. I've got this one in my own portfolio. Can't remember when I bought it, but the motion trader signal would have been. I'm just looking where these moving averages crossed and the price breakout was. So I'm thinking the motion trader buy was probably around probably in early 2023, and I'm probably in somewhere around there as well. Although I'm only guessing, I can't remember off the top of my head. But look, this is a nice, clearly defined uptrend. It's probably one of the best performing gold stocks out there. A new high. I've got no intention of selling mine. I'm just letting the trend do its thing. See where it goes. You just never know. This could be like a blow off top and that's it, or it could consolidate and keep running. Could do all sorts of things. But my process is let profits run, give them room to move, and see where they go. I'm not operating on a take profit basis. I'll wait for this to ultimately peak and come back and trigger my trailing stop. RMS, another gold stock. In terms of buying Emerald here, I'd be hesitant to buy it as well, though, because it's it's just had such a big run. I do struggle to buy stocks which have run a long way. It's a lot of them. Some of them keep running a lot further. It's just I just find it harder to assess the risk reward when a stock's run a long way and is at all-time highs. That's just a me thing. It's not saying you shouldn't do that because it's buying into strength. I just find it harder to assess risk. RMS, look, it's it looks a bit like an advanced version of evolution in that it had the run up, it's had the sideways consolidation, and it's got the breakout. I think this would be a motion trader stock as well. I'm looking where the moving averages crossed. Could have well got a signal possibly in January, if not January, probably around March. I like the way it's traded in the rally above the moving averages. This is one of those things we talk about quite a bit, where a market runs above the averages, and I say, look, it's getting a bit stretched. Looks like it needs to pull back to the averages. Very much what's happened here. Pull back to the averages, and now it's run again. Interesting for those who like their chart structures. I was talking about this on my Self-Wealth video tutorial during the week, the live video I'm doing with the Self-Wealth guys. Just that little head and shoulders reversal pattern. You got the shoulder, you got the head, you got the shoulder, you got the breakout. Coincided with around the time the motion trader signal probably was. So it's interesting how you can line these things up sometimes. So I like Ramulus, and it's one I'd be keeping if I had it. Don't have that one though. Let's see what else. Gold as a triple top resistance. Well, gold is this an asymmetry entry point? Look. As I was saying with gold, I think there's that prospect for it to pull back in the near term. I think this is a really strong move. I think the move needs some sort of consolidation, and then from there, if we do get a consolidation, then we can start to work out, okay, so where's our exit point for a breakout, and that's when we can start looking at our asymmetric setups. At the moment, big run, getting close to big overhead resistance. It's a news-fueled rally, so I'd be a little bit careful about gold just there. So jumping back to these stocks, GRR. So I think that's Grange Resources. Yes, it is Grange Resources. Iron ore stock. Any guesses what I'm going to say here? There we go. We've got those moving averages. It's a stock which I spoke positively about this stock. I remember being on AusBiz in 2022 talking about Grange Resources. Don't remember when it was, but it would have been during this period when it was above the rising moving averages. But there really hasn't been much need to buy this stock for a while. I'm just looking and wondering whether there would have been a motion trader signal during this period when the moving averages crossed. But I'm pretty sure there wouldn't have been, because after maybe there was. I'm not sure. After the averages crossed, I don't think it broke to a new high. I'd have to have a closer look. But there certainly hasn't been any reason to buy over the last 6 months. It's not a play I'd want to take now. I want to buy into momentum, particularly in a market which is currently like it is. Having a look at CXO, Core Lithium. Wonder whether it's I'm wondering whether it brought itself up off the floor, and it hasn't. It's like, I know people love buying these stocks which are down and out, and they can be, if you nail the turning point, you can do really well. Like a stock like this could look trading at 33 cents. It could be trading at 66 cents in no time. It could double in the space of a couple of weeks, but it's so hard to nail those turning points. Like look at the rally we got off the March low from 70 cents to $1.20 in the space of a month or two. So you get these really big swings when a stock's in these downtrends where you potentially can, but it's hard to nail the low, it's hard to nail the high, and you often, if you get in at the wrong point, you run the risk of being caught in these downdrafts. So it's one which I just have to leave alone. I'm going to make more money by buying with the trend rather than trying to pick reversals. Reversals look tempting. You just think, look, can't go any further. Surely can't go any further. It's worth a punt. But I'm sure people were saying that in July after the big fall, saying, look, great potential. It's got to be worth a punt, and it's hard to gain. So got to be careful. Got to respect risk, particularly in this environment. I just keep saying this environment is just not a great one for speculation like that. Arrow formwork, one I've got in my portfolio. Again, it's one of those smaller caps which is performing well. It's bucking that trend we're seeing in the small ords. Big rally, rising moving averages. It's pulled back to the averages. It's holding despite a very ordinary market. It's had a big run. It's really had a large continuous rally since really the March 2020 low. Did have a lengthy almost maybe a 9-month consolidation in 2022, but it held its ground. It didn't go into a big downtrend. I don't know how much further this stock has to run, but I'm holding. I've got my trailing stop. I'm using my Motion Trader trailing stop for this, same as my Motion Trader members, and I'll continue to let this one run. So I'm going to have to wrap this up in a moment because we're getting close to 50 minutes, and that probably does most people in. So I've done ACF. CHN I covered CHN a couple of weeks ago. LTR has been a takeover play, which has come back to earth, I think. Look, not one I want to play. I'm not playing gaps down below moving averages. I just don't know where that goes. And last one, let's make this lucky last for the day. Kogan. And it was one of those boom ones during the that COVID recovery period. Big downtrend. Look, just another great example. Avoid stocks which are trading below moving averages because you never know how far they can decline. So there's been from the way I play this, there's been no potential for buying Kogan. There was no potential for buying Kogan from late 2020 all the way down. See, it's below these declining moving averages. I wouldn't have tried to pick the low in Kogan all the way down, and that's going back to what I was just saying a moment ago about trying to pick lows. Became interesting in January 23 when it broke above, when the moving averages turned to the upside. It was a Motion Trader signal. I'm not sure exactly whether we got a Motion Trader signal in February or potentially over here in June. I actually looked at it myself. I was going to buy a few of these somewhere around June, July, but I never got to it. I missed it. I was distracted with other things, and I didn't get to it, and it ran. That was frustrating, but that's just the way it is. It has since pulled back, but I think had I bought it, I'd probably be exiting it now because it's now. I'd had to calculate where my trailing stop was, but it's at that point where I'd be saying, look, it's now below the moving averages. The moving averages are rolling over. They haven't crossed yet, but they're close to crossing. We've got downward momentum today. Like, look at this. We've got a bit of momentum to this downward move a few weeks ago. We've got that shallow rebound, that classic shallow rebound, forming that flagging sort of pattern. And we're breaking down from that again. It looks like it's going to test lower levels, so it's not a dip I want to buy. I'd want it to, before considering this at this early stage, I'd want to see it back above the probably the September high to at least go, okay, maybe there's some sort of basing structure. But it's for me not a play at the moment. Well, I think we might call that a wrap for this week. So hopefully it's been interesting. Hopefully you've enjoyed that. Hopefully you're enjoying these live sessions. If you're not watching them live, hopefully you're enjoying the replay. You really only need to come live if you want to ask questions, or this time of day works for you. The replays are just as good. So look, thank you for joining me. Give me that like if you haven't already got to doing that, and look forward to coming back, having a chat to you next week. Till then, bye for now.